elections coming up next year.
Yes.
What perfect timing to the sunset of the Tax Cuts and Jobs Act.
Right.
You think maybe they're going to use that as a political football, right?
It will be. It already is. There's a couple of aspects that are already the political football that we'll see what happens. In the election at the end of next year, it depends on if there's a blue wave or a red wave. Either way would make some tax changes happen. If there's continued gridlock, then there's going to be tax changes just due to the sunsetting of prior tax law.
Yeah, here's what I'm looking at. I'm looking at what our deficit is right now, national debt, how much money we owe.
You might be the only one worried about
that. Well, yeah. Well, I look at it, and the conclusions I'm drawing is then, as far as what they're saying, is we don't collect enough tax revenues. That's code for taxes are going to go up. And one area where they keep hammering, and I think there's signs everywhere talking about, well, let's go after the wealthy and, all these planning techniques that, we've become accustomed to. And some of them on the radar, they've talked about grats before. But the big one that I'm seeing, and especially because it's in the sunset provision, is the estate taxes. And so right now, what's the number now for the exemption?
The exemption for 2023 is 12.92 per person.
And that's going to go back down, revert back to half of that, right?
Correct.
Inflation adjusted. But what I'm seeing is that when they keep talking about we don't have enough tax revenues, they might go after that further, right? They might try to lower that even more, which puts us in a position where, and we've talked about this on this show with valuation experts before, where time's running out. And so planning needs to be done. But what's your take on, if they go after that, there's some techniques right now, planning techniques that are useful. They might not be around much longer. And we know the IRS came out a few years ago, talked about, hey, if that exemption is use it or lose it. Mm-hmm. So what's your take on it? If I'm a business owner, or we own a privately or closely held business or wealthy family, and we see the writing on the wall, what's your take on as far as, go time and some of the planning techniques that are out there?
Yeah, absolutely. So I think that we kind of frame it in the next 2 years. The lifetime exemption for gifting and estate planning is going to go up each year. It'll end at around the end of 2025. It'll be somewhere in the 14.5 range based on the current interest rates and inflation increases that will be allowed in the years to come. And then the Tax Cut and Jobs Act will sunset at the end of 2025. So on January 1st of 2026, you'd wake up and the lifetime exemption would be around $6 million inflation adjusted. And so ultimately you're going to lose, a person could lose anywhere from 8 to 9 million of gifting power in that one day change, essentially. And so the goal is to create awareness over the next 2 years that this change is coming. And so if you're a family that has a business that has value and you're developing a plan for how you want to get it to the next generation as tax affected as possible, then now is the time to start looking into the strategies of gifting. In the past, if people were paying attention to some of the inflation reduction or the Build Back Better plan, some of the hot button items were the changing in the allowance of discounting. And discounting is the biggest way to move wealth to the next generation at a reduced amount. It was cut out of those bills, and so it is still in effect, but it's the best way to move the wealth at a reduced amount. So what I mean by that is if you have a family, patriarch, matriarch, that have somewhere in the $30 to $40 million of family wealth range, you've got about 2 years to do some planning in order to really move that on to the next generation and save tax in the future.
Yeah, so when you said that discounting survived the bill, basically the lawmakers decided, hey, let's not touch this. Surprise, surprise, because maybe they want to take advantage of it.
Right.
But when we're talking about discounting, give me a little bit more meat on that. What is discounting?
So discounting is where you take an entity, and there's two different types of discounts that can be applied against that entity. There is a discount for a lack of control. So if you think about an investment, where you or an individual might own 10% of it. You don't have control of that entity. You don't have any ability to influence the direction that company goes in, what they do with the money, the growth model. And so you're just a silent investor along for the ride. And so there is a discount that can be applied to not being able to control the entity. That's the first discount. The second discount is called lack of marketability. And the discount for lack of marketability is in a lot of privately held investment vehicles, partnerships, LLCs, S corps, whatever it may be, the operating agreement will describe that the investor or an owner cannot sell to just anyone. There's limitations to who they can sell to. So what that means is you can't take your ownership and go out to market and just find somebody to buy it because there's limitations within the agreements. The other thing is there's not an open market to just go sell these private investment vehicle ownership pieces. So those are the two discounts that are afforded for a gifting scenario. The two discounts, each one of them, to be roughly compliant, is up to about 20% of the value can be discounted for each of those buckets. And it depends on the type of vehicle it is, ownership vehicle. It depends on the type of investments that are in that vehicle that allow that make that discount go up and down from 0 to essentially 20% for each of those buckets.
Okay, so I'm an investor or owner. I have a bunch of assets. Maybe I have some real estate, some mineral interests, stock portfolio. So I'm going to take these assets, I'm going to put them in an entity, and let's say it's, like you said, $30 million. With the assistance of professionals, I could maybe reduce that from an estate tax point of view, reduce what the value of those assets are by maybe up to 20%.
Really, you can adjust it almost up to 40%.
Okay.
So it's 20 per bucket at the most. So, 20% of that 80%. So maybe it's 36% that you can totally take a deduction on. Yes, that is the way that this is set up. So you would take assets, whatever they may be, investment accounts, real estate, working interests, royalty agreements, leases, things like that. It could even be, rental houses, a beach house, a ranch, anything that you really have that's of value that you think could go up as well. And you would put those into a vehicle that has some of the limitations that I just described so that you can take advantage of discounting as it moves to the next generation.
In one of those vehicles that is often used, family limited partnerships, right, here in Texas. So can you walk us through what that looks like?
Family limited partnership is simply a limited partnership with one family or that's essentially controlling it. So the family limited partnership is a model that was originally built that was able to avoid some Texas franchise taxes and other franchise tax type other tax effects that were beneficial. But what they then created was this opportunity to protect assets of the family from litigation and protect from any creditors who might want to, attach themselves to those assets. And then in addition, creates the opportunity for you to take advantage of discounting in the gifting scenario. So family limited partnership is a limited partnership that has limited partnership interests, meaning just that. Those ownership units don't have a say. They don't get to vote. They don't get to control the entity. They are merely quiet investors that are along for the ride. And then there's a general partner. The general partner makes all decisions, all investment, legal, distribution, payouts, anything happens with the business is determined by that general partner. The general partner will generally own a very small percentage. It only needs to own 1% in order to run the company. And so usually a family limited partnership will be set up with a general partner that owns 1 to 2% and then limited partners that own the rest.
Okay, and this is where the gifting comes in and this is where the discounts comes in because initially, let's say, senior generation sets this up. and they transfer the wealth to junior generation or subsequent generations?
Yes.
So how does that work?
So what would be done is you would set up the limited partnership. The matriarch, patriarch would contribute their assets, the ranch, the investment accounts, real estate, as we discussed, into this family limited partnership in exchange for owning 100% of the limited partnership and the general partner. So the general partner is actually usually set up as a company. It can be set up as a management trust. It can be set up as a corporation. Really, any type of vehicle can own it. But that entity then would be owned by the matriarch and patriarch in order to still control the entity. Then they would own the 99%, let's say, limited partnership to start with. Then they would have a valuation done on the limited partnership, and it would value a 1% interest as a limited partner. A valuation firm would come in, do the valuation of all of the assets, and then determine that a 1% ownership is worth X, discounted is worth Y. And that Y is the number that gets used against your lifetime exemption. So if you were to take a $30 million value of assets that went into this limited partnership, depending on what category they're in, you could potentially reduce that down to, say, 22, 24, 25 million, something like that, depending on what percentage of discounting you get.
Okay. So what you're saying is, we're using these numbers as examples, but in your example, you took a tax-paying estate to a non-tax-paying estate just by taking these steps.
Yes. And ultimately what that saves, that same 30 million in 2 years, it might go up because hopefully everything rises as far as the investments go. But by using your exemption now, instead of having only 12 million, matriarch and patriarch each get 6, and having a taxable estate of 18 million, which results in 9 million of estate tax due, ultimately that's where having to sell the ranch to pay the tax comes from.
Right. So and the way I'm looking at it, it's not just a 9 million in savings, but as you said, if you have to sell the ranch, now you're getting rid of income generating assets.
Right.
And it could be a lot more than just 9 million, right? You could have debt attached to it, all kinds of different things. And then let alone family harmony where kids start fighting over who owns what of the breadcrumbs. That's potentially, classic story. So by using a vehicle like this, obviously there's a tax savings, but also, if I'm not mistaken, I think you mentioned it, there were some asset protection features that go into this, right?
Correct. Certain pieces of a limited partnership can have claims attached to them and some can't. And then generally speaking, a general partner cannot have those claims attached to them. So what it affords the entity is that the general partner can decide to not make any distributions, and therefore the creditors wouldn't receive any benefits of the assets of the company. And so therefore the limited partnership would just continue in existence, keep all of the cash inside, and not have to distribute anything to a creditor. In addition, the general partner can take a management fee from that entity for managing those assets.
So we got a situation here where, I'll just call them senior generation. Senior generation has all these assets, and they put it into this vehicle. They offload the assets on paper to junior generation. So they've avoided the inheritance tax for now. So the growth is happening in the junior generation's estate. So the family continues to profit from these assets without having a tax burden. They got some asset protection. But even with their 1% ownership or running the general partner, they're still controlling the 99%. So they haven't given up control. One of the things that, and we talk to business owners who are ready to exit and they have a hard time letting go. One of the things they always tell us is, I'm not ready to hand over the reins. Well, here's a vehicle where you're not, you have control. You're not handing over the reins to the kids. They have the bulk of the money on paper, but at the end of the day, senior generation is still controlling what's happening all the way until, they're dead or incapacitated. Right?
Absolutely. And there's another layer to this, and I don't want to get too complicated for everybody, but the gifting that is done is generally done into a trust or a grantor trust of some sort, so that the tax is still paid by the patriarch and matriarch. the trust value gets to grow and the estate value of patriarch matriarch continues to go down. In addition, there's ways for them to be the trustee of the trust or, investment advisor to the trust. So they still have control over not only the limited partnership, but over the trusts that are now the beneficiaries, which can also be generation skipping trusts, which means that now you've not just gone one generation, but another generation as well.
Yeah. So you're a CPA, so I could ask you this question.
Yeah.
So when they're making the determination if they should make that as a grantor trust or not a grantor trust. So in this case, we were talking about senior generation sets this up as a grantor trust. So they're recognizing all the income tax liabilities, right?
Yes.
The kids own the assets, but whatever income or whatever tax liabilities come up, it's coming back to them, the senior generation. And so that's another way of gifting, right?
Correct.
It's a way of passing on assets and you keeping the liabilities. So what would make somebody determine if they should make it a grantor trust, generally speaking, grantor trust, or pass on the tax liability to the kids in this case?
Really, it depends on the size of the estate and what assets are able to be passed on and how much remains in the patriarch or matriarch's control or estate. That's what determines what you want to do with it. If the total value that the family has is this $30 million and we just gifted it, well, then we don't want them to be grantor trusts because mom and dad now have no money. It's all in the partnership. And so in that scenario, you might have the trust pay the tax, or depending on the age of the dependents or the beneficiaries, you may flow the trust through as a complex trust and then the individuals pay. It's a matter of sitting down and developing a plan, understanding the assets that are available and what we want to accomplish. And then there's ways to change it so that it fits what you desire.
Yeah. I want to ask you a question on this. So we're talking about children. Oftentimes we're referring to adult children,
right.
But there's instances where folks with young children, minors, they have significant assets and they've been thinking about planning. What do you see this, or do you have an opinion of this one way or the other, where families set this up where the minors are the limited partners?
Yes, we do. Generally speaking, it's going to be in some sort of trust. The trust is going to have provisions in it for distribution to those beneficiaries at certain points in their life. As an accountant, you can imagine I'm a little more conservative, so I tend to want those or recommend that those distribution ages are further out. You're a different person at 25 than you are at 45, so I think that generally I like to see those spread out a little later in life to protect the kids from themselves. But yes, you can have minor children have trusts that are taking part in this family wealth. Generally, they don't know what's in them. The trustee might be their parents or older siblings, things of that nature. But they can still be utilized in this scenario.
Are these trusts that are set up for the children, are these usually revocable or irrevocable trusts?
They have to be irrevocable trusts.
They have to be irrevocable trusts if they own interest in the LP as a trust.
In order to have the gift truly work, it has to be an irrevocable trust because there can be no clause to bring the money back, essentially.
Well, no, I meant for the children.
Right.
Is it the children's revocable trust or children's irrevocable trust?
Irrevocable trust.
Okay.
If it's a revocable trust, technically I can, if I'm the giftor,
yes,
right, and I gift it to a revocable trust, I can always change the trust and the beneficiaries back to me or somehow to benefit
because they're the minor, yeah.
And
okay.
so then essentially the true gift didn't take place because all access to that money needs to be severed from the person gifting it in order for it to qualify.
Yeah, especially if you're trying to take advantage of the exemption in today's environment as opposed to when it's we a lot of people expect to be a lot less and after the sunset.
Yes, absolutely.
So we've had valuation expert in here and talking about how they go about and what the IRS looks at when they're scrutinizing this thing. So 2025 is not that far away.
Right.
And so, and I joke about this, there aren't enough qualified appraisers at this point to deal with everybody. And so the time to do it is quickly running out. But from that perspective, though, and the IRS knows this too, a lot of you are going to try to get things done. In your experience, are there certain things where people rush to put these things together where they make these massive mistakes where the IRS challenges it successfully and they kill this whole thing? What are some of the pitfalls that people run into other than waiting until grandma's, on her last breath before putting this together?
Usually the pitfalls are, we're talking about a plan that is very legal in nature. And so you need to make sure that you're talking to your advisors to build a plan out the way that you want it and to make sure it's effective. I'm talking very generally about provisions that need to be available. But, when we're looking at this, each trust has a form of doctrine in it that allows trustees to do certain things, beneficiaries to do certain things, and all of those can ruin the plan if they aren't done correctly. So I think the biggest thing is to make sure that your advisors are all on the same page, have them get together and put a plan together, and then make sure you dot the I's and cross the T's before it's done.
What about, is there certain types of assets that you shouldn't put in the FLP? Yeah. That people like to maybe put in there that kind of screws things up?
There are some concerns about putting, personal residences in FLPs. If you put the ranch into an FLP and it's, not strictly an investment vehicle, and, technically mom and dad are living at the ranch and it really is their home, you can get, issues with with essentially piercing the corporate veil, if you will, where it was for the benefit of the patriarch and matriarch, and you might lose some of your legal protections if you do that. There may need to be rent charged to the parents, that sort of thing. So again, it's a matter of diagramming this out and trying to identify the assets that are going to be beneficial. Usually you want to put assets into the family limited partnership that are going to go up in value, because you're going to take advantage of the discount now, and then in 3 years those assets are going to be worth a lot more, and now you've been able to pass on even more at an effective rate.
So let's talk about that specifically. Middle market company, privately held. They're contemplating a sale maybe down the line. There's no active buyer right now. Right. Option one, sell the company, liquidation event, then pass on the money to the next generation. Mm-hmm. Option two, put that into the FLP, get the valuation discount, turn around and sell it later on. Now you get to use more of your exemption, right? So, okay, that sounds great, but if the intent was to circumvent taxes, IRS is not going to allow for that, right? So what's the rule of thumb here if, other than if somebody already has a buyer, obviously you can't do that. But what is the IRS looking at when they say, hey, wait a minute, you did this with the intent of circumventing taxes here? What are some of the issues that may arise and which speaks to, start planning early, right? Don't wait until the last minute to do this thing.
The longer distance that exists between the date of evaluation and then the closing of a deal, the better. There's nothing that says that, an LOI is binding and therefore you knew you were going to do this deal. But generally the optics are going to dictate that. And the benefit the IRS has is they have hindsight's 20/20. So they're going to point to this and say, this is what you were doing. However, like I said, if you dot your I's and cross your T's, get the professional valuation done, and everything is taken and closed before, or moved and gifted before an LOI is signed, then, there's the documents would line up in your favor to say that you didn't know that something was going to take place. So,
yeah, Jack, from your perspective, doing these deals, do you see any difference if a company is owned by individual or by their FLP?
No, I mean, typically a buyer might come back and say, well, we want the ultimate owners to join into the agreement to backstop some of the representations that are being made. But it's something that you're working around. So if you set up an FLP and decided, now's the time to strike, right? We want to put our active business into the FLP. You're going to want to at least, but you have an idea that, hey, I'm going to make an exit. I don't know when, but I know I need to make it soon. You're going to want to, plan around that. understand and try to understand what a typical buyer might want to see in terms of a structure or in terms of the way that the business is taxed, right? And what the ultimate consequences that might be for that buyer's bottom line. Because you could make maybe a tax election that seemed good right now, but then you're going to pay for it later when the buyer says, well, that doesn't work for my valuation. Ultimately we're going to have to pay all this tax. So that's something that you're going to want to, as you're taking these FLP steps, you're going to want to also have somebody helping you think in advance. Okay, this is what buyers typically like.
Yeah, and that's a very good point you bring up, because we run into this a lot of times where you have the accountants say, hey, let's do this because the client's asking for, hey, I want maximum discounts, or I want to pay the least amount of taxes right now, and they don't consider what is going to happen later. Or you have a situation where someone is listening to this and say, oh, let me go get myself an FLP, but then the accountant's like, well, wait a minute, what are you doing? Because later on, there might be some tax issues. So it really speaks to what you said earlier, Chris, which is have a team of advisors talking to each other. So in a typical engagement where you engage with a client and they're thinking about this, what happens? Do you recommend that you reach out to their legal advisor, or do you facilitate that? What's the best practice, so to speak, that somebody should go through?
So in putting something like this together, I would recommend that there's a meeting, with the attorney, the investment advisor, the CPA, and then the family, and determine what's going to be the best course of action. Everybody has an opinion about the way to go. As Jack said, any type of M&A transaction, generally speaking, you can solve for whatever entity it currently is in. But, if you have an FLP, they're not going to want to buy that because it owns more than the business. There's a number of things that need to be done to line up for an M&A transaction anyway. And the more your team of trusted advisors are working together, then the better prepared you're going to be for an exit, or not an exit, but just a transfer of the entity to the next generation. So yes, I think the first step is to get your professionals on the same page, get them in a room. Let's look at all of the pieces to the puzzle and figure out the best solution for the family.
Yeah, and I would say what's kind of interesting about this moment in time and the expiring of the exemption is that, usually a business owner will have an exit, they'll have a sale, and then they think, oh, I need to do FLP or estate planning attorney. And what we're saying is more or less right now, and this environment is the opposite, is you should be thinking about this now and not waiting to getting the big event happening before, oh, let me go, now I need to go handle this. So there's it's a little bit of an reverse order in terms of intuition for a lot of business owners.
Yeah, but let me kind of put on my business owner hat here,
yeah.
Okay, and kind of in response to that, yes, I agree with everything that we're talking about, but as a business owner, I'm like, I don't want to add complexities to my life. I got a business to run right now. It's just one more complexity. Plus there's the cost, right? And so that's kind of what goes on in our heads. So to that point, let's talk about, we talked about the FLP. What does it take administratively on an annual basis? How much of the business owner's time is this taking? What are the costs? But what are the things that have to be done to maintain this? Because it's not a set and forget thing, right?
No, it's not a set and forget thing. It is a company. So you're going to need company books, company agreements. You're going to need to do the accounting on an annual basis for the assets that are in there and money that comes in or money that goes out. And then there's an annual tax return that's going to be needed for the business as well. So, it's going to cost $4 or $5 grand a year just on average to take care of and run the business.
Right. So there's a cost, but then you said it is a company. Yeah. So you still have to follow good corporate governance.
Yes.
Right. So there's some work to be done
yes.
here. It's not a set and forget it thing.
Correct. But generally it's the ranch, it's real estate that you're already managing, it's investments that are already being looked after. I mean, there's not any additional maintenance for the things that you're already taking care of. It's just making sure that you document it within the company.
Yeah. So one of the reasons I actually like this as a planning technique and why I think it's, it makes a lot of sense is, besides all the benefits we've talked about, what a great way for the senior generation to pass on some of their values as far as how their relationship with money to the junior generation, to teach them about, why did we make investments in these particular assets? How do we think about managing this? How do we, analyze what advisors to use? It's a great technique. Do you see, Chris, when you're dealing with, obviously these are multi-generation families, do you see that most of the senior generation brings the younger generation to the meetings with you guys?
It's a mixed bag. I think that there's a general feeling of, I know I need to do this. And the matriarch and the patriarch know they need to do this. But they've worked so hard in some instances to develop it, it is very difficult to give it away. And what we see a lot is they love their 3 children dearly, but they're not quite ready to trust them with ownership of these assets just yet.
Right.
It is a long-term discussion to get people comfortable to do it. We see a lot where they say, okay, I'm going to give 99%. We're going to give all of the LP interest to the 3 trusts. And then when it comes down, well, we want to keep 30%. Let's give the 3 trusts 70%. Well, maybe, and the number slowly starts to go down, and you have to start talking to them about the effects of what that does to their family in the future. But it is, make no mistake, it is a difficult thing for people to give away their money, no matter how much they have.
Even though they're still controlling it.
Even though they're still controlling it. Right. And some of that, they're, it's in this company and I don't know what I can use. I don't know what I can do. So it takes some education from the advisors to help them get through what their options are for running this business. And
one of the things that I see, which is, you might find this interesting or not, is senior generation has all the best interests, but their kids are just not interested. And what's funny is a lot of the times the kids, they don't care about how much money there is. They're just not interested in money. And the senior generation is just shaking their head saying, wait a minute, you don't realize how hard we've worked for this. Yep. And so even though they want to pass on their know-how, not just the money part, the know-how, the kids are disinterested. Do you have, you see this with different families and the different dynamics, but what's your advice to the senior generation that wants to not just pass on the assets, but the knowledge, but the kids are simply not interested?
Well, there's usually what takes place is you have, let's say there's 3 kids in that example again, and you have one who went to New York to be a stockbroker or something, and then you have one who's in the family business and wants to take it over, and another one is out in Seattle kayaking and doesn't care. That's usually the scenario, right? The one that's in the business, capable, going to be able to take it over. Stockbroker's doing great on his own, not worried about what the family's doing. And the third is living the life of Riley and enjoying and doesn't care about money and doesn't want to be involved and doesn't really care to know. And so then how do we sit down and make this fair, right? Because one of the kids is going to feel like they're enriching the others by building this business and creating opportunity. And so then that's when you get into the big complexities. It is something where maybe in those scenarios, it's not an equal split. Maybe the parents will sit down and say, this is what we're going to do, and they're going to like it. And that's it. Maybe the son in Seattle, we're just going to carve off a piece for him. It's going to sit in a trust. It'll just take care of him. We don't have to worry about it. And then the upside goes to the child who's growing the business, and maybe the daughter in New York that's a stockbroker. Maybe there's some other plan, and they're not worried about that true equality, if you will. But it's equal from a overall taking care of the kids standpoint, but not from a percentage standpoint.
Yeah, we've talked. Jack and I have talked about this a lot, where once senior generation passes, that's when all the fighting happens amongst the kids. Mm-hmm. Unfortunately, it happens way too often. But in this case, the FLP survives the senior generation. Mm-hmm. And so it could go on multiple generations, right? If they so choose, if everybody gets along. But oftentimes, what is the most prevalent thing that happens when senior generation passes?
So you brought up a good point about the fighting. The fighting usually happens when there's no plan. And then that's when the tensions grow within the family, and the money is sitting in a pot, and now you've forced your 3 children to be partners in a company together, or manage bank accounts equally, and there's no direction to what you want to do. And in Texas, a will is a great document that has stood the test of time, but a will in many cases doesn't always describe all of the things that you need to worry about. The will can create a testamentary trust that then dictates, but usually it's not as robust in documentation as setting up an irrevocable trust before death that then dictates what takes place after death. And that is where the benefit of planning comes in, is it will lower the level of fighting. It will never get rid of all of it, but it will lower the contention, because you're going to create these trusts. You can choose to involve them in what's happening ahead of time. You can let them know that this is the goal, this is what you've got, this is how we're going forward, and deal with that up front so that the whole family knows and has less to be upset about later.
In your experience, do most people get that junior generation involved in the planning, or is this like a shock after senior generation passes away? They're like, oh, this is what they wanted.
In my experience, actually, there's been more and more involvement. Now, they don't get much of a say. They're just kind of told, this is what's happening. I set up this trust. Here's the provisions of the trust. And, the kids at that point are, okay, I'm good with that. There's not much to say, because then now they got to fight mom and dad, not their brother or sister.
Right.
And so it's easier to just accept at that point, I think.
Right.
Now, easy to accept is not necessarily true, don't get me wrong, but the more you plan, the better the result can be.
Yeah. So we talked earlier about using the gift exemption to move the assets and let the growth happen in the junior generation's estate. So now we have this scenario where senior generation passes and the kayaker says, I just want my money. I'm not interested. Lo and behold, at this point, though, taxes were never paid. They're not inheriting. They're not getting the step up in basis. Now they got to pay taxes, right? Capital gains taxes?
Depends.
Okay.
Right. So if it's been gifted to a trust and the trust is owning the limited partnership piece, usually the trust tax work gets done along with the partnership tax work and the patriarch tax work to make sure that everything is taken care of before death. Okay. So that is a recommendation. If the trust has been sending K1s down to the beneficiary and the beneficiary hasn't been paying taxes, it's kind of on the beneficiary at that point. I mean, to some extent, there's nothing you can do, but understand that there's a problem. I do get that.
Right.
But generally, we recommend that the tax work is all done by the same person who's working with the family to make sure that everybody's protected up until death. After death, people do whatever they want to do, and that's fine.
Yeah. So go ahead. I'm sorry. Go ahead.
But in the case of the kayaker, the trust would dictate what they can take, what they get out of the trust, when it goes to them, that sort of thing. There's a number of provisions that can be set up in the trust that dictate those sorts of items. The trust can be set up so that the trust pays the tax, which means whoever's the trustee has a fiduciary responsibility to be taking care of that trust and taking care of the funds within it. And so that's one of the ways to protect it as well.
Yeah. Just side question. Do you guys provide trustee services as part of your offering?
We do not do specific trustee services, no. Okay. Generally, trustee services, we recommend to use a third party at some point in time. Depends on kind of the value within that trust in order to make it worthwhile for a third party independent trustee to take over.
Yeah.
But they're very advantageous when they're needed. Absolutely.
You're talking about the trustees?
Yeah,
the
third-party trustees.
Yes. Yeah. No, I've had people reach out to me and ask me if I would be the trustee, and I'm like, absolutely not. I don't want to. I mean,
that's what you do. Yeah.
There's.
I thought you liked
the many things.
No. It's I mean, talk about a more thankless job, right? I mean, you got all the liabilities. No one's ever going to be happy with you.
No one's going to.
By definition, no one's going to be happy with you.
Right.
Someone's always going to be upset with you. So, so if I'm, if I have some assets outside of retirement accounts, right? We're talking about assets outside of retirement account that's going to go into the FLP. As a ballpark, I might be listening to this. I may have a small business, and I'm thinking to myself, well, I don't have $30 million of assets, but it's not necessarily for people that have that much assets, right? I mean, typically, at what point? Again, general, nothing specific. At what point does it make sense for someone to start looking at, from not just a gifting perspective, but from an asset protection perspective, but also, Jack, if they have a business of some sort that's growing, at what point should somebody look into this and say, hey, is this something that might be right for me?
The beginning number is 2 to 3 million in kind of liquid assets that you would put into a family partnership that make it so that you don't just have 3 million of cash in a bank account that if somebody were to sue you, they could take.
Yeah.
So that's kind of the general rule to creating this vehicle. From an estate planning standpoint, if you have a business and assets that are, north of 12 million, then you probably need to start taking advantage of this in the next 2 years before it sunsets. We got less than 2 years, just so you know. It's September already. I know, exactly. That's true. And you've got a short window to do it. As you said, the professionals are going to be limited in their ability to help. But if you also have something that's got an opportunity to skyrocket in value or go up quickly in value, and you're already kind of at that maybe I should do it point, then it's better to do it now and capture the upside in someone else's estate so that you're protected now. And you're able to transfer it at a much lower level and maybe even keep gift tax exemption options later while the increase is able to be used by the family.
Okay. So how long, from kind of first call you get, I know some of this is dictated by how fast the client moves and how organized the client is, which we talk about a lot. Organization is key. But generally speaking, from the first call you get to when we have it all set up and it's in a kind of a stable situation and we have the appraisers, how long does it generally take?
So I would say that basically what you're looking at is about 4 weeks of legal discussions, and that's depending on how fast the matriarch, patriarch can make decisions about who gets what. That kind of slows things down. As I mentioned, it changes quickly when they think about it. Oh, I want to change the ownership percentages. I want to keep a little more. There is anxiety that's going to go into this and thoughtfulness that needs to take place. And so I would say it's going to quit on the fast end, 4 weeks from the legal standpoint. It is going to take about 3 to 4 weeks on the valuation standpoint, depending on how complex it is. The more complexity, the longer it's going to take for every piece. And then from that, once that stuff is done, it's maybe another couple weeks to just get everything really kind of finalized. So you're looking at about a 2-month process, probably on the fast end, is what I would estimate.
Yeah, I mean, I think that makes sense. What you're saying is 2 months on the fast end. So it's something, and there's, like you said, there's a lot of tough decisions to make. So, and that's if you come in, you're organized, you know what you want to do mostly, right. You know where you're heading. You listen to our podcast nonstop and you've already figured it out, right?
Yeah.
But I think people need to understand, you don't want to wait till middle of next year. You want to start thinking right away. Start meeting some advisors you want to engage with and start getting that ball rolling.
Yeah.
If you're sitting here in September of 2025 and saying, I got to make some phone calls to get this done, I don't know if you're going to be able to get it done.
Yeah, it's not going to happen. Right. Because right now kids are back in school, so everyone's into planning mode. So and then it lasts until about Thanksgiving, right? Because then the holidays start. So really you're looking at September, October, and half of November is when people do things. Beginning of the year, everybody says, we'll do it later this year. Then summer happens. And really, I've been in this business for a long time, and I'll tell you, those 2.5 months from now until Thanksgiving is the busiest we'll ever get in planning in a year.
Absolutely.
You know, you'll have your one-offs, but this is it. So don't wait until 2025. Anything else you wanted to add to this, Chris?
Not really. I think this has been great. I appreciate the opportunity to come in and chat with you. And
if somebody wants to get a hold of you and they want to talk about this, how do they get a hold of you?
Yeah. So I'm Chris Masters and the managing shareholder of Houston for Doeren Mayhew. We're a middle market CPA firm focused on helping our clients grow and maximizing their savings through tax planning and business planning and estate planning. So the market that we're talking to is who we like to work with.
Information contained in this podcast and accompanying video have been derived from sources believed to be reliable. This content is not guaranteed as to its accuracy and does not purport to be a complete analysis of the topics discussed. Analysis is based on assumptions that may not come to pass. None of the content should be construed as legal or investment advice. You should consult with a qualified professional before implementing any strategies discussed. All expressions of opinion reflect the judgment of the speakers on the date the video was recorded and are subject to change.